Hi there and welcome to our investment process video. I'm Rob McGregor, the founder and principal advisor at McGregor Wealth Management, and I've been helping people build and look after their independent retirements for the last 20 years. I'm guessing you've probably come to this video because we've sent you a link, in which case welcome, and I hope you get a lot out of this. If you've found this video by other means, and it is designed for clients of McGregor Wealth Management and those becoming clients of McGregor Wealth Management. If you found it by other means, then please, by all means, take it all in. Reach out to us. Do not act on this without getting good advice, either from us or someone else. So the idea of this process, this video is designed for people who are long-term investors. It's designed for those who've got a goal and a plan in place to achieve financial independence and a great retirement. That is our clients, that is the people we look after, those that are financially independent and those that want to be financially independent, quite simply. It's designed for those who want to make good, smart decisions about money and avoid the bad mistakes around investing in money, who value good professional advice and who've watched our video series or come to a meeting with us. So they've got an idea about what we do. And ultimately, they've either had an appointment, the wealth potential appointment or retirement appointment. So this video isn't designed for those who don't have a plan, not clear on their goals. I'll talk more about that, but very hard to help people on their investing if they don't know where they're going, which is a plan. It's not designed for speculators or traders. We are absolutely long-term investors. We subtitle our investment process exciting life and boring money, and not the other way around. So we're not traders, we're not punters, we're not speculators, and we don't believe that's helpful for long-term wealth preservation. And we're not get rich quickers, so you're going to hear good principles in this, not any wild schemes or plans. And repeat that warning again, this is general advice, so that means I don't know your specific circumstances yet, and you shouldn't act on anything in this until we've delivered a statement of advice. Okay, let's get into it. What we're going to cover in this video, we're going to cover the mission for your investments. In other words, why are you investing in the first place? We're going to have a look at the big challenges to having a good investment strategy, and there's lots of them. We're going to have a look at how most people, including professionals, mess it up. And we're going to have a look at the 4 foundations of a great investment process. We're going to have a look at how to put it all into practice for you. So firstly, to the mission, what's the purpose of your investments? And quite simply, we build a pool of investments to provide for our living expenses. We do it to pay for the nice things in life. We do it to pay for our passions and pursuits, the things we love to do. We do it to allow us to help those who are important to us, our family in particular, and potentially to leave a legacy. So that's why we build investments. They're for a purpose, and I want to distinguish investing versus some of the other terms, but ultimately investing is a long-term thing, part of a plan for us. So some of the big challenges for people, firstly, it can appear very complex to most people, and it is. I've been working in this industry since superannuation became compulsory in 1984-85. That's now a long time. I don't like to say it, but that's 35 years. So there's a lot of rule changes in that time. It can be complicated. And we're actually not designed to be good investors. Our brains are still wired as they were in prehistoric times, where if we hear a rustle in the grass, if we hear a noise, we're designed to run, flight, or we're designed to turn around and fight, or to freeze, fight, flight, or freeze. And they're not good traits when it comes to investing. Often when we hear a rustle in the markets, our best thing is to hang on and ignore it. So our brain wants to panic right when we should be just holding still. So not being clear on our definitions and purpose, in other words, why we're investing. So let me talk about my definitions of investing and some of the other words. But we've got saving, and saving is putting money aside to eventually buy something and for the unexpected. So it might be having 3 months worth of living expenses set aside. It might be putting aside money for a holiday. It might be putting aside money for a car, for a house renovation, but we're saving to spend or as emergency funds. So we're not necessarily chasing a high return. We want a good return, but a high return is not what we're chasing. Investing is buying good assets that produce both rising income and ultimately will go up in value. And generally, a good investment has income, whether that be from property and rent or shares and dividends, And the rising income is what causes those investments to grow. And I'll talk more about that. Speculation is where you buy something hoping the price will go up. And generally, a lot of speculative assets don't have income. Think artwork, think gold bullion, think vintage cars. So you're not producing income, you're just hoping the price is going to go up. And ultimately, gambling is where you place a bet. Excuse the typo there. And if you're right, you win. And if you're wrong, you lose all of your money. So even though Winks might have appeared a good bet and a certainty at $1.06, if you lost all your money. Whereas for most investing, you get a decent return and you're very rarely at risk of losing all your money. Actually, a quick definition of investing, you're almost never at risk of losing all your money. If you have a risk of losing all your money in investment, there's a fair chance you're speculating or gambling. So let's keep going. Let's have a look at the 4 foundations to a great investment strategy. And these are all really important, and we very rarely see people get them all right. And the first is to base your investments on a strong personal financial plan, and I'll talk more about all of these in a minute. Second is to learn from history. History doesn't always repeat, but it often rhymes, and we go through cycles in investment markets and economies, just like we go through cycles, that is seasons, in the world, in our climate. Thirdly, to understand and manage the behavioral traps, and this is the biggest risk you face, and it's the biggest determinant of your long-term returns, which is your behavior. I'm going to unpack that and talk more about that. And ultimately, to invest smartly, and that's to get all the little things right. And if you handle all these 4 things, you will have solid and good investment returns. So let's have a look firstly at personalized planning. And personalized planning to us always starts with goals. And GPS Wealth, the company that we're part of, the company that I co-founded, the reason we call it GPS is quite simply goals, planning, and strategy. It's also a pretty good analogy for what a GPS does in navigation, and that's what we aim to do for people investing. So the GPS navigational tool, you put in where you want to go, that's your goals. It works out where you are, and then it tells you exactly how to get there, and it changes that these days through changing road conditions. It might tell you some detours, etc. Now, first thing to note, a GPS is absolutely useless if you don't know where you are, and that's why it starts with with a good assessment. Your plan is always based on your current situation, not somewhere else. So we then work out the goals. If we don't put in a goal, it can't take us there. And these are your financial goals, your estate planning goals, retirement goals, other personal goals that require money. Ultimately, it's what's the mission of the investments we're going to build. And we build a plan to achieve those goals, and a plan is just where am I now? Where do I want to get to? What are the strategies and actions to get us there? And then what do I do to start now? And then ultimately, those strategies we just talked about, and multiple strategies, one of which is a smart investment strategy, but other strategies are things like superannuation contributions, negative gearing, dollar cost averaging into a share portfolio. They're all examples of strategy, and ultimately we need an investment strategy that has these smart components I'll talk about in a minute to get us from A to B, to get us to our goals. So key insight, all investing should be done as part of a long-term plan. So a quick history lesson and some observations. This is a chart from my friends at Andax that I've been using for well over a decade now, that is designed to give my clients and me a good reminder of what happens in history. Now, the dark blue line there is the share market, the Australian share market, and it shows the value of $100 invested back in 1950 and left to grow with the dividends reinvested. So this is the latest version, so it finishes at the end of 2018. It's it's August 2019 as I record this. So this is an annual update, just so we can keep these things refreshed. So we update this video once a year. So it'll be relevant, at least for the next year. Well, it's always relevant because it's timeless. So $100 has grown to $200,000 over that period of time. So a long-term return in the share market of 11.7%. Now, important that includes inflation. So if you look at the red line, you'll see inflation over that period averaged 4.9%. So given we're in inflation of about 1.5% at the moment, we adjust return expectations, which I'll talk more about at the end of the video, in line with inflation. So in this example, the share market has returned inflation plus 6.8%. And we just allow inflation plus 6% for growth investments. And that's been pretty consistent throughout the history of Australia and the US. So the light blue line is a balanced investment process. So it's achieved a long-term return of inflation plus 5.5%. And that's in a mixture of shares, property, and bonds and cash. And you'll notice the light blue line has less ups and downs. So on the way to, now a lot less return, by the way. So over that 60-year period, about half the accumulation, even though we've got most of the return. And that's the effect of compounding. So you'll see this is a logarithmic scale. What that means is it shows on the right-hand side $100 to $1,000 to $10,000 to $100,000, and on the way to $1 million. And they're all jumps of times 10. Now, if we have a scale that's not a log scale, so it's just a linear scale, these charts look useless because they look like they're going off the chart in more recent times. So what a log scale shows us is the actual growth in not in real terms, but in constant terms of how much are we increasing our wealth. So in that 68-year period, our wealth has increased literally 2,000 times. So, and it's increased 100,000 times for a balanced investor. The green line is bonds, so it's only increased 144 times at a return of inflation plus 3.5%, about 7.5%, and cash in the bank has returned about inflation plus 1.3%. At the moment, we're showing inflation of about just under 2%. You would expect cash to be 3, but cash is closer to 2 and under. So we're in a period of low returns on cash. And that's a big issue for lots of our clients. Not so much for those paying debt back, but for our retired clients. So very important that we understand these cycles and this history. So let me now make some quick observations about this. And keep in mind the dark blue line's the share market. So let's talk about the share market. And firstly, the market goes up way more than it goes down. About 80% of the time the market goes up. It's only 20% of the time that it goes down. But it does go down regularly, including small downs and including the occasional bigger down. And sometimes it goes down a lot. We've actually had 7 downturns since 1900, where the market has gone down by more than roughly 25%. So they're what we would call a lot. The others are normal, inevitable, and unpredictable. It always recovers eventually, and it's quite interesting. We're well and truly recovered on this chart for people that were reinvesting, and the market is bouncing around its previous highs of 2012, even for those that aren't reinvesting at the moment, and they've had dividends all the way through to spend. So the market does always recover eventually. That's if you're invested in the market, and I'll talk more about that shortly. And an observation here, you can never predict what the market's going to do in the short term. You can make some assessments, but you can't predict. But you can always predict what it will do in the long run, and that is it will go up and it will fluctuate. So that's the normal. There's some quick lessons from history. I love this chart, and they stopped making this a few years back, but this goes back to 1900. And as I said, 7 downturns of more than 25%. So they're the red chunks. Now, you'll note the market's always had a great run before those, and I'll talk more about those in a minute and a framework for managing that. But in the long run, that market's averaged 12%. And you'll see that this graph in the middle of the graph, which shows the spread of returns. So we've had 1-year returns as high as literally 90%, and our worst returns for 1 year, about 42%. The market has dropped up to 50% over long periods of time, but we're talking about the annual return here for rolling 12-month periods. So somewhere in your lifetime, you're going to see share market drop between 20 and 45% return over a year. That is the normal. It's like having certain winter weather conditions. They're going to come around every now and then. So let me add a framework to this that we use to help us put sense into the market, and where we might do some slight adjusting. We do like to own shares as part of a long-term wealth portfolio because they quite simply provide the best returns when you're investing, not when you're trading or speculating, but when you're investing. So we talk about the share market in 3 main stages. The first that I'm going to talk about, it's not the first stage, but it's the fear. So that's these times where the market's dropped by more than 25%, and people are scared. They're scared that it's going to go all the way down, by the way, which it never does, but they're scared that they're losing their money, which they can do, and it depends when they got into it. But it's interesting, the fear always follows the FOMO. So let's call FOMO a boom, and you'll see my whiteboard copy on the right-hand side there, which many of you will have seen, and you'll see, if you haven't seen it yet, you'll certainly see it because we use it as part of pretty much most meetings. But the market goes through that boom and bust, or that FOMO, which is fear of missing out. followed by the fear. Now, one of my wonderful clients once said, "Oh, Rob, they're both fear." And it's quite true. In the boom or the FOMO, we're actually fearful of getting less returns than our friends, family, and neighbors. So people might say to me, "Rob, we've got 15 or 18% in the last 3 years, but my neighbor's got 30. Why aren't we invested in yada, 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 whatever's driving that latest boom?" And it might be high tech, it might be mining companies, but things that are going to bust more. And generally, whatever is driving that market during a boom, the things that are driving it will actually have a worse downturn when we get to the bust. A good example, in 1987, the market was being driven by entrepreneur stocks and gold stocks and platinum stocks in Australia. So we had a massive boom. The market had doubled in 18 months. It had tripled in about 3 years. And that's one characteristic of a FOMO market. The market will have doubled in between 2 and 5 years. At the moment, by the way, it's taken 10 years to double. So we're not even close to FOMO. And that, once again, is a reminder, in August 2019 as we speak. So what happens in a downturn? So in that 1987 downturn, where the market had tripled in 5 years, the market dropped 50% pretty much in one day and started bouncing in. But gold, mining stocks and entrepreneur stocks were down 90%. So the people that had been getting excessive returns, they saw their returns drop by up to 90%. So that's one of the biggest dangers for people, is during that FOMO period of getting caught up in whatever's hot. And that's our job as advisors, to make sure you don't. So fear, FOMO, they only actually cover the market for about 10% of the time. Most of the time we're in this boring space in between called the wall of worry. So that's all those small wobbles as it wobbles up the hill, but we're still always worried. At the time of recording this, people are worried about Trump, they're worried about the trade war, they're worried about all these little things that keep coming back that don't really affect anything in the long run. And I'll talk about some of these examples shortly. And that wall of worry is most of the time. And the reason, eventually we go from wall of worry into a boom. And that's when people stop worrying, and all of a sudden everyone piles in, and that's why the market doubles in that 2 to 5 years. And ultimately, though, it will eventually be followed by a bust, the fear, when the market comes back to normal. And it's interesting looking at, for this chart here, those red lines I've just popped up, that's where we've gone to the bottom of the market. We've gone back a couple of years and fast forward 5 years. So we're showing a 7-year period, and pretty boring, nicely up in all those periods. So the danger time is during the boom. That is the biggest danger time, and our job with our clients is to make sure they make smart decisions then and avoid the dumb mistakes. And there's a lot of bad mistakes you can make during those booms, which will lead to money. And for our retired clients who are coming into cash, or anyone who's coming to cash of a significant lump sum, it's making sure we're careful that we're not investing all of their money at that time, which is pretty rare for a start. It is every 18 to 20 years, but we do need to put that in, because everyone's always worried that they're going to invest at that time. So let's have a look at one of my favorite defenses against that, and we call it dollar cost averaging. And this is for people particularly who are building wealth through investing in the share market every month, but we do also use some of this strategy sometimes for people that have large amounts of cash that we want to get into the market without too much risk. So dollar cost averaging is just a concept where we're investing a regular amount into an investment. So in this example, I've used the regular amount of $1,000. So we're going to do a monthly investment of $1,000. The price of the units or the shares or the fund that we're buying into are $1. So quite simple maths. We spend $1,000. Each unit costs us $1, so we get 1,000 units. Really simple. Now, we're not designed to be good investors. We're really good when the markets go up, but we're scared of those downturns, of what happens when the market goes down. So I'll give you a good example of this. And let's say we've got into work one morning, we've decided we're going to start our investment program. We log into ComSec and we're going to do it ourselves. We're going to buy $1,000 worth of some investment. Let's pretend it's BHP, but it doesn't really matter. We put our investment on, we buy our investment, we get busy, we go to lunch, we come back from lunch and we've got a few minutes spare. What's the first thing most of us are likely to do? And I've been asking this question for 20 years and everyone always answers correctly. We'll check the price. We've only been invested for a couple of hours and we're already waiting to see whether it's gone up or down. If it's gone up, we pat ourselves on the back. If it's gone down, we say, damn, Should have waited till this afternoon. It's quite funny to think about, but it's what we do because we're fearful of investing. So we're all good when it goes up. Let's have a look at what happened when it goes down. So we started with our first month with $1,000, and the next month the market's down. It's down 25%, and I'm obviously using an exaggerated example to show the impact of a down market, one which will be less likely to happen than any scenario you'll ever encounter. So market's gone down, we're down 25%, but look at this, we get more for our money. We're now getting 1,333 units. So if this was a shop and we were buying, say, pens, and the pens are $1 each, right now it would say pens on sale, 25% off, and we'd think that was a good thing. This is what the media should say when the market's down, but what does the media say when the market's down? They use negative words like blood on the streets, millions wiped off, and I'll show you a few examples shortly, but they're nothing but negative. They're hardly talking it up as shares on sale, great time to buy, which they should be. And I'll talk about why in a minute. So let's say it gets worse and the market drops 50%. We can now buy twice as much for our money. So yeah, the prices drop 50%. The media should say, once in a lifetime opportunity, getting quick, these prices will never be repeated again in your lifetime. But they don't. They actually say threat of depression, meltdown, and people are actually seriously worried. I've worked through 2 of these 50% downturns, and I can tell you there's not many people lining up to get into investing. The people that invest at the bottom of the market are those that are very experienced long-term investors, those that have good advice, and the dollar cost averages. That is, those are just investing every month regardless. Now eventually the market goes up, and as it does, so it goes back to 75 cents, and let's say we're buying 1,333 units again, gets back to $1, we're buying 1,000 units. So in this exaggerated 5-month period, we've bought $5,000 worth of shares. The price has gone from $1 down to 50 cents and back to $1. So if we looked up the Sunday paper, it would say the performance of that investment over the last 5 months is 0 because it's gone from $1 to $1. But we've picked up 6,666 units, and at $1 each, that means we're worth $6,666. So we've made a return of just over 30%. So not bad for a down market. Now, 2 things have had to happen for that to come out. One is the market had to go down and then come back and pass where it was. It had to make a V, and that's all the market does. It goes up, and when it goes down, it comes back and makes a V. And the other thing is that we had to just stick to our strategy and keep buying. So that's the way we love investing in the market for people building wealth. Sometimes for people that have a lot of money ready to invest, we'll also do that. And it's a great way to protect from the volatility of the share market. And I'll talk more about how we protect from the volatility of the share market for retirees shortly. So let's have a look at the ways that investors do mess it up. And they do mess it up, and I'll share with you some statistics in a minute. But most people mess up their investments, and they do it in one of 3 broad ways. They might not take enough risk to get the return they want. So that might mean at the moment they're in term deposits getting 2%. They might take too much risk and blow up their money. And they fall victim to many of the behavioral traps, which basically means they bounce between those first 2. They get excited when the market's in a boom, in FOMO, and they start investing, but then they panic when it gets to fear, and they get out and they miss out on the returns that are available just by holding for the long run. So let's have a look now at the number 1 contributor and the number 1 detractor to your long-term portfolio returns. And they're exactly the same, and it's your behavior. But let me get to that. Traditional theory, modern portfolio theory, says 90% of your return comes from asset allocation. So that's just how much shares you've got, or much growth assets, what you've got in shares, what you've got in bonds, what you've got in cash, and 10% comes from timing and selection. So that's which shares, when do I buy, when do I sell? And that's true if people were rational. So it ignores that number 1 influence, which I said was behavior. Now, this modern portfolio theory, which is a very good piece of work, which was done in the 60s and 70s, it made 2 assumptions. One, that markets were efficient, and we've seen from some of those big changes that markets are probably not highly efficient. They're very efficient in the long run, but they're not efficient in the very short term, particularly. So 1, markets are efficient. 2, investors are rational. Now, in my 20 years plus of looking after investors, I've never met a perfectly rational investor yet, including myself. We have those emotions, we have those feelings, so that clouds the way we look at things. So just to reiterate, that number 1 influence is our behavior. So that's what we do. The biggest risk is our behavior, and that's making bad mistakes at the wrong time and missing out on the simple but effective good things that we need to do most of the time. Now, the evidence of this comes out annually in the Dalbar study of investor behaviour. This study's been going for 30 years. The recent one's just out and it reiterated exactly the same thing. But I've got some slides here from some of that research that show how that comes about. So in this first example, and this is for the 10 years to 2013, so the GFC right in the middle of that, share returns, which are on the left-hand side, this is a US study, but the behaviour is exactly the same in both. US shares are about 7.4%, international shares about 7%, so modest but still healthy. And you'll see bonds during that time were about 4%. So a good balanced investor who is roughly half in shares and half in bonds should have got returns of about 5.5% to 6%. But they actually got returns of that red bar, so 2.6%. So half the potential returns they blew up by their activity, panicking. And generally this goes like this. They're in bonds because they're scared, the market starts to go up, then they put more and more in shares, then the market goes down and they go back to bonds. Now that blows up half their return over that period. And this has been happening consistently. This shows the gap just in the share market between the returns that shares got, which is the green line, and the returns investors in shares got, represented by the average equity fund investor, which are at least half or less. Now it's quite damning, and it shows you that why we say that investor behavior is the number one determinant of return. Now the good news is when you put that together with the stats on modern portfolio theory, it means we get at least half our return from our behavior, we get at least 45% from our asset allocation. If we focus on those two things, we're pretty much locked in 95% of the long-term returns. And you'll see when I go through our methodology, that's what we do, and that's why we're consistently in the top group of investor returns. Not necessarily the top investments, but compared to most investors, we're at the top of those green bars. So key insight there, the returns that investors get is very different to the return their investments get, quite simply because most people don't stick to a plan. So how do they mess it up? Now the letters in mess it up give us some mnemonics on remembering some of the ways that investors mess it up. So the first is the media, and we can't let the media be our advisor. The media is negative 90% of the time. I did a seminar last week. I asked people how often they thought the media was negative. They actually said 100%, and it's probably closer than the 90 that I've said. This is a good example. There's a couple of headlines here. The first one, 24 billion wiped off ASX amid tightening tantrum. Now this is from March 2015, but you see these headlines all the time. As I record this, I've just read the financial review and it said we've just had the worst week this year. Now I forgot to say, up until a week ago, we'd had the best start to a year ever. And they forget about this, so they never put it in perspective because bad news sells. So they want to scare you to make you keep buying, watching, subscribing, whatever the media is that you're subscribing to. Another one of my favorites for two reasons is this one from 2008. So this is at the bottom of the market, GFC. Market's been going down for ages, and it says Britain faces worst recession since 1990s. Now that's interesting, and I know that's going to scare most people. So after the bleakest quarterly inflation report, so that's once again negative language. And this is interesting for two reasons. One, it's a big negative, worst recession since 1990. It's now 18 years later. So that's a pretty good time to go without a big recession. But let's have a look at this chart again. And you'll see in this index chart, the blue bars here are recessions. And if we put a highlight on those recessions, you'll see that every single time a recession is one of the best times to buy shares. Definition of a recession, 2 negative quarters of GDP growth. So by the time they announce a recession, we're about 8 months in. And if you look at all those things, if you look about 8 months in, it's pretty much the best time to be buying shares in the cycle. So if all you ever did, and I'm not recommending this as a policy, was buy shares whenever they announced a recession, you would do very well. Now, we didn't have a recession in Australia in 2008 during the GFC. The rest of the world did. We're the only developed country to not have one. But that was quite simply because we had a mining boom going, and that saved us. If you took out the mining sector, the rest of the economy was in a small recession. Now, just another note on recessions, they're not actually that scary because they're scary for the people affected. So let's say unemployment during a recession goes up from 5% to 7%. For 2% of people, that's a really bad thing because they're now newly unemployed. For the rest of us, we've still got our job. Life goes on as normal. And often interest rates are coming down, so we'll save some money. Often inflation's coming down, so we'll save some money. But we're being scared by the newspaper with signs like worst recession that doesn't make us want to invest. So it's quite interesting. So don't let the media be your advisor. That will drive your emotions, which we know from that prehistoric brain that we have is not the best way to make investment decisions. I'll put the next two up, the two S's. The media and most advisors will have a short-term focus, and it's often about single issue obsession. So as I write this, it's about the US-China trade war. But if you go back in history, there's been Asian crisis, Russian crisis, bird flu, SARS, Y2K, no end of single issues that we now forget, and we'll forget this one in the long run, that makes us focus on the short term, which makes us lose money. So very expensive. The I stands for illiquidity, and there is only three ways to lose money in the long term. One of them is not having enough cash when markets are down, which means you have to sell at a bad time. I'll talk about the others shortly. Then T, timing and selection. We all think we can time the market, but nobody can. There's almost zero track record of anyone being able to consistently time market over long periods of time. Warren Buffett, the world's greatest investor, makes no attempt to time the market. He does what we do. He assesses the market conditions and might change his investment strategy around where that's at, but no predictions on timing the market. So, and I'll talk more about that with some statistics in a minute. Oh, here we are. So Warren Buffett made a bet against some leading hedge funds back in 2007. So keep in mind this was before the GFC and the nearly 50% downturn in the share market. He bet them. He was trying to make the point that good long-term investing will beat active fancy investing every day of the week. So he bet a big bet. Started off as a small bet, turned into a big bet. They said, let's put $1 million each, and you guys can invest it in 3 or 4 of your best hedge funds, and I'm going to put it in an index fund. And an index fund is a fund that just tracks the market, or the blue line, compared to what I've shown in those graphs. So in this case, the market dropped pretty quickly. So the market went down, but it started to come back. And the hedge funds beat Warren in the first year, but they didn't beat him, or very rarely again. Now this chart shows before it was finished, but I've got some information on now on the final result. So you'll see the A, B, C, D, E hedge funds, their returns over that period, and they range from 0.3% to 6.5%. So pretty ordinary, really. Warren Buffett, by using the index fund, made 8.5% compounding over that year. Now that's huge. That would have doubled your money over that period of time compared to just preserving your money for some and others where you might have made a total gain of 20 to 30%. So absolutely huge. And that was by using a simple passive strategy. And keep in mind, that was invested at the worst possible time, just before the market dropped. So someone that followed that strategy and they got unlucky on the timing has still doubled their money over that period of time. And that includes dividends in this particular example. So a good example on 2 rounds. One, we can't time the market, and we don't actually need to. One of the other ways to lose money, and I said there's 3 main ways to lose money, is if you're not truly diversified. So those 3 ways to lose money, 2 of them are about our behavior. So one is if you panic and sell when the market's down. The other is if you have to sell when the market's down. So that's about that illiquidity, not having enough liquid assets to get through any downturn. And the other is if you're not truly diversified, if you don't own the broader share market. So if you just owned BHP during the share market downturn, or Rio Tinto, your experience of the market is very different than those that own the blue line or the index, which is the whole market, where we're happy to have the average of the market, which is very good returns. Performance. We tend to focus backwards on funds that have performed well, and a lot of our industry will put out in front of you investments that have performed well on the misguided assumption that they'll be the ones to perform well going forward. Let me give you an example of this. There's a company called Morningstar, and this data comes from them, from a Vanguard study. But Morningstar rate managed funds, or mutual funds, as they call them in the States, as either 5-star, 3-star, 2-star, or 1-star. And you would think 5-star funds would be better and would perform better. Now, looking backwards, this shows where cash flows go. So this stuff matters because people look at these things, and you'll see most of the money is going into 4- and 5-star funds. So in this case, you would think they'd be the best performers. But then you look at what happens, and this shows 3 years later the returns of each of those classes of funds. And you'll see 5-star funds underperform the market by the most, closely followed by 4-star, followed by 3, 2, and 1. So in this case, you would have been better off to invest in 1-star funds over the next 3 years. So it's a classic case of why chasing performance costs you money. And it's one of the reasons we prefer index, because that takes away as chasing performance, and we actually get the benchmark returns, which is better than all of them, because you'll note they all underperform the benchmark. So this reiterates that in another way. This shows a whole bunch of funds, which is the whole market, 534 funds, and it shows those that over the next 10 years, and this was from 1999 to 2015, 15 years in this case, and it looked at the yellow funds, those which survived and underperformed, the orange funds, and some of these survived and outperformed, but then the rare ones, the red ones, which are the ones that survived, outperformed, and never experienced 3 consecutive years of underperformance. Now, why is that important? If you're in a fund and it underperforms for 3 years, what are you likely to do with that fund? And from my experience, what everyone does is they get rid of it. They go 3 years, it's underperformed, I've got to get into something that's performing. So the chances of picking a fund that survives, that outperforms the market, and that doesn't underperform for 3 years is 4%. So only 4%. And just to put that into perspective, some of you may know a game called 21 or blackjack, where the aim is to get to 21. So if we're playing 21 and we have these 2 cards, which total 20, are we going to hit or are we going to stand? Now, everyone I've ever asked that to would absolutely stand because they've got 20. There's only 1 card that can save them, which is an ace. And what are the odds of getting an ace? It's 8%. So it's exactly twice the odds of picking a managed fund that's going to outperform, not have 3 consecutive years of underperformance, and survive over a 15-year period. And yet that's what investors and advisors, most advisors, have spent years doing, is trying to pick funds that are going to outperform. And it's a waste of time, and it's more importantly, it's a waste of your money, when index funds will achieve a better result than 96% of funds, which you're going to have trouble picking the 4% anyway. So the cost of that bad behavior comes up in terms of results. I want to show you a quick example. So keep in mind, investors get less than half the return that their investments get. So in this example, I've pretended inflation's 1%. It's not that far off at the moment. And someone has $1 million and they're going to draw out 50,000 of that each year. So 4,167 a month. So if they draw out 4,000 a month, you'll see the green bar shows if they get a return of inflation plus 5, they're pretty much preserving their capital. So let's have a look at what happens if they mess it up, if they don't invest with enough growth in their portfolio, or they chop and change and get half the return or less. So in this case, a 2% return, so more like term deposits, or more like they've messed it up, their money will run out in 23 years. So if we go back to this one, in 23 years in this example, they've got nearly 1.2 million, call it 1 million in real dollars. In this one, run out of money. So the value of getting this stuff right is huge. That's $1 million over 23 years. And we do know that most people get it wrong. And that's the averages. So if the average gets it wrong that much, that means some people are getting it very wrong and they're having worse performances. Now, we know all our clients get it right. So once again, that skewers those averages. Now, on your way up, while you're dollar cost averaging, while you're building your investments, it's absolutely just as shocking. So in this case, we'll look at the difference between a 6, an 8, and a 10% return. So 4% difference, which is pretty much the difference between either boring cash returns or solid long-term share market returns. It's also the difference between people getting it wrong and making mistakes and getting it right. And it shows over that long-term period, it's a difference of nearly $1 million for a 30-year-old starting out. They've only got 30 grand in super at this case. They're putting in their contributions. They've got a salary of 50,000 going by 4%. So that pretty normal person is going to miss out on $1 million just by getting that wrong. So very important to get that risk profile and then the investment strategy right. It's absolutely critical. So let's have a look what I mean by smart investing. And once again, SMART, just an acronym. Firstly, getting the structure right. That means low cost, tax efficient, and for us, predominantly index. Not all index, but predominantly index where we actually get those returns. Let me give you an example on fees. This is an extract from the Productivity Commission report on their analysis of super and their investigation into super. that came out in recent years, and it shows the fees on retail super funds, so they're funds like AMP, BT, these types of things, and not-for-profits. These are like the industry super funds, and you'll see much higher for the retail funds. Now, that would be good if they delivered high returns, but we've just seen that 96% of those funds don't, so it's not a very good bet. Now, if you look at on the right-hand side, it shows the spread of fees. So industry super funds or not-for-profit go from almost no fees up to about 1.5%. And there's a long tail of expensive fees. But in the middle, there's a median, there's a common cluster which goes from about 0.6 to about 1%, which is a reasonable fee that not-for-profits pay. It's also pretty much the amount that our investment process costs. So let's call that 0.8% in the middle. That's roughly what most of our clients would pay for their investment process. So highly comparable with industry super funds or those not-for-profit funds, and yet delivers way more transparency in terms of the visibility of what you see, way more customization, and more sophistication as well, which you'll see. So it is delivered, and I can't reiterate that enough, at pretty much industry super fund costs. So secondly, having a strong methodology, and a strong methodology just means you can survive through ups and downs because you know what you stand for, you know what your investment principles are, and that is the CARE process, which I'm about to introduce you to. Once you've got those things covered, and as long as you've got the behaviour covered, then it does get down to asset allocation, which does drive 90% of those long-term returns. Rebalancing, by regularly rebalancing between all the assets that you hold, it adds between 0.5% and 1% to your returns. And the research on this is very clear over long periods of time. So it is effectively a free lunch. It does effectively pay for the advice that we give you. Over time, it will absolutely recover those costs. Time in. So once again, you saw the time in the market in those situations. If you put it in and let it grow, you will get the results if you avoid those behavioural mistakes, and then we get everything else right around the asset allocation. So some of those keys of modern portfolio theory, and I've touched on them. One is diversification. Most people intuitively know that, not putting all your eggs in your one basket. If you're not diversifying, if you just have a small number of investments, you're effectively speculating on those. And once again, that's a different thing to do and not very successful for most. Asset allocation is just designing how much goes into each asset class. And for most of our clients, they're going to be balanced to growth investors in retirement and growth to high growth investors during their accumulation, because it makes total sense. And rebalancing just means if we regularly rebalance that, we'll add 0.5% to 1%, which effectively pays for the cost of advice. So putting it all together, and we have a look at then we'll have a look at our process. So a GPS plan based on your goals, and your plan will always be based on who and what's important to you. Wealth creation strategies, and then separate the investments you're going to personally manage. So we'll ask you what you want to manage, and we'll separate your property investments. We then construct your portfolio using our CARE investment process, which is based on all these principles, which I'm going to walk you through. And that will include your super contribution. So the smart strategies that we'll be talking about for most accumulators are going to be super contributions, debt recycling, investment properties very carefully selected, right place, right time, and building an investment portfolio. So let's have a look at the CARE investment process, and it's simply an analogy that stands for these four buckets or four portfolios that we run for most clients. The first, and I'll go through each of these in turn, but it's built on those four foundations: modern portfolio theory, investor behavior, learning from history, and personalized planning. So let's have a look at the core first, and this is where we just have a spread of different sectors: Aussie shares, international shares, different types of international shares, property, bonds, etc. We're index-based predominantly, 100% for the share components in our core portfolios, which gives us those market returns at a low cost. So it works, and I'll show you some of the results of this shortly with some returns at the end. The strategy is long-term buy and hold, and it's in line with that long-term risk profile, which for most of our accumulators will be high growth, and for our retired clients will be either balanced or growth. And as I said, we may average that in depending on where markets are up to. And that'll be 25 to 80% of most people's portfolio. The active investments are between 5 and 20%, and it's where we may attempt to take some profits from time to time. And when I say from time to time, it's probably only in that 3 to 7 year window range. So it's not a daily, weekly, a monthly, or even an annual thing. It's only when we think markets are starting to get into that FOMO stage and we will put effectively like a stop loss where we'll take some profits if the market starts to go down. So it's a way of sheltering a little bit. Now, we can't predict these things perfectly, and we don't need to, which is why we only have 20% of the portfolio in that, which does at least provide us with a buffer to protect during those times. The most important buffer, however, for retired clients is what we call the reserves portfolio, and that's where for our retirees we'll have up to 4 years worth of their spending needs in defensive assets, cash, short-term bonds, those types of assets. So someone that had $1 million who was pulling out $50,000 a year, we would have $200,000 invested in short-term assets. Now the income from the other portfolios goes into there, so that gives them between 6 and 10 years worth of liquidity, which is one of those three ways that people lose money. So they've got time to ride out the downturns. And lastly, partly to compensate for that, and partly to tap into long-term returns, and partly to give you an interest, because index funds aren't that interesting. They work, but they're not that exciting. We run a small portfolio up to 30%. For most people, it's around the 20% range of direct Australian shares and some international shares. So this gives us high returns. We do have a high risk there. We use very conservative managers here, quite deliberately, and that gives us a bit of interest. And you get to see all these in your portfolio, which means you're more likely to stick with it during a downturn, because you look at companies like BHP or the banks and go, well, they're not going broke anytime soon, so they're just having a temporary downturn. Whereas when you see an XYZ Australian share fund and you don't know what's in it, you may not make as good decisions. So put it all together, and this is an example, and I can't stress enough, you've got to be careful on past performance, particularly where that performance is driven by people taking big bets or being quite active. I put this up as an example because we have been running this process, been running it for nearly 20 years, but for over the last 5 years as a managed portfolio. That's where we're using exchange traded funds and the like in a very structured manner, that all our clients are in different versions of this depending on their own unique circumstances. But in the last 5 years, the core balanced portfolio, as an example, has delivered about 7.3%. In the last 3 years, 8.84%, and you'll see the high growth returns there. The care just means we add the active and the enhanced in, this shows for those what you would get, slightly higher for some, slightly lower, but similar sorts of numbers. And that is for the whole care portfolio, excluding the reserves. The reserves for retired clients will knock about 1% off these returns, which gives us the numbers that we can plan with. And on the right here are my long-term frameworks. And I stress long-term here, over 20, 30 years. In shorter term periods of 5 to 10, it can go higher or lower than that. But you've seen those long-term charts I use, and the market does go back to these in the long run. And this is after reasonable fees. So allowing for fees of about 0.8% for the investment process, which means we can plan for this quite carefully. So good returns, consistent returns, pretty much just a bit over index, but puts us in the top 10 to 20% for most times compared to our peers. And most of the active managers on this type of thing, the banks and these things, are in the bottom quartile. So quite interesting, and we compete very strongly with industry super funds. We would sit up there at the top. Industry super funds most of the time in a much more transparent and much more sophisticated process that works towards your plan. So that's the presentation. In summary, personal financial planning always done first. Investing is a critical part of your plan. Investing can be complex. We're not actually designed to be good investors. Our job as your advisor is to take away the complexity, to make it simple, and to help you have peace of mind about knowing you've got a good investment strategy. Through that good investment process, which is based on strong foundations, and we review it regularly, which gives us the coaching of you to stay in there, make behavioural decisions. For clients in this process, we send out a monthly video on what's happening in the world and why it matters or doesn't matter, which is quite often the case. And it should be on track it should keep you on track to achieve your goals. It is goals-based planning at its essence, and it's all about achieving your financial goals in the long run. We call it exciting life, boring money. We do want you to have an exciting life and not exciting money. I've found exciting money leads to losses over time. I hope this video has shown you some of our philosophies. If you have any questions, please yell out, and I'll be talking to you soon about your investment process. Rob McGregor, McGregor Wealth Management, signing off. Have a great day.